Hi folks, good morning. Joe McQuaid here, Wealth Preservation Associates. I hope you've had a chance to view some of our earlier videos comparing the performance of some direct market investments with some other retirement planning options that in the long run might be the better choice to protect a hard-earned nest egg. If you haven't, and if this is the first time that you've had a chance to view one of our videos, let me introduce myself. And to some of you who have had a chance to see the videos, let me reintroduce myself. My name, again, is Joe McQuaid. I am the principal at Wealth Preservation Associates. And more importantly, I'm probably a person just like you, concerned about retirement. Like most of my clients, my wife and I don't have $1 million in the bank, and we do have a need and a desire to have a comfortable retirement. Again, like most of my clients. What I do is focus on a conservative approach, a moderately conservative approach, using insurance-based solutions that I have actually utilized in my own portfolio for my own retirement needs. So I do not need to spiel the insurance company hype. I do not need to cloak myself in their mantra. I can reference my own personal experiences with these solutions. I also want to say that I agree with much of what the pundits say, and that no one solution is the holy grail of retirement planning solutions. What we have are appropriate products, appropriate solutions based on timing, financial situations, and overall retirement objectives. In this series of videos, of which there are 4 short videos, we will talk about number 1, the fixed indexed annuity. That will be the topic of this particular one, and then following we have additional modules to talk a little bit about some creative options that come along with a fixed indexed annuity, and then finally we're going to talk about the profile of a fixed indexed annuity type of client. And again, I'll probably reference quite a bit back to myself at that point, because I am a fixed indexed annuity, as a matter of fact multiple fixed indexed annuity products in my portfolio. So let me start with the definition. Fixed. Fixed meaning it is a fixed interest option that for extremely conservative folks will lock in the growth in a guaranteed account. Now, lots of times people might say, well, if I'm going to do that, why wouldn't I want to just do something like a CD or a savings account or something of that nature? One will be the size of the guarantee. In a fixed indexed annuity, invariably you're going to get a higher fixed rate, and with this depressed interest rate environment we've been in for the last 5 or 6 years, that can be critically important. Number 2, with the fixed indexed annuity, not only do you get the fixed interest rate guarantee option, you also have some of the other creative income rider options and some of the other things that we're going to talk about in the other videos. But it's important to know that they are available to you. Second word in the fixed indexed annuity is indexed, meaning there are options to select indexes that track well-known stock indexes. But different in brokerage accounts or variable annuities, the index selection does not risk your premium or locked-in annual gains. Much more on that in a few minutes. I'll go into a little bit more detail on that because it is a little complex. Final word in it is annuity. Annuity meaning it is a contract between the annuity owner and the insurance company which obliges the insurer to deliver certain promises, the most well-known being guaranteed lifetime income, and in return the annuity owner agrees to place the money for a period of time, usually 10 years. There are shorter and longer term contracts, but 10 years is the most popular. Now, if I could use an automotive analogy, this definition of the FIA, the fixed indexed annuity, is the basic vehicle. No options, no real bells and whistles attached to it. So again, definition of what a fixed indexed annuity is. The FIA of today is light years ahead of the fixed indexed annuity of just 10 years ago. To stay competitive, the insurance companies have begun offering a myriad of options to jazz up the product, make it more attractive to different classes of buyers. And that's why lots of folks who are going to be viewing our videos have various different objectives and various different goals. And a lot of these products of today are are built to try to take care of a lot of those needs. This is meant to be a short video, so for me to go into all of the options would become an epic mini-series, and we're going to leave that for the next couple of videos that are going to follow. And they will be the subject matter in those videos. But before I do that, let me get back to the index. This is probably the most difficult piece of the annuity puzzle to understand. To do it, I refer you back to my earlier videos, hopefully you have had a chance to see them, where we show the difference between a direct investment in the market and an investment in the market through an FIA. Directly in the market, you realize the entire gain of the market, minus, of course, your advisor's commissions. In an FIA, you realize a portion of that gain that the market experiences, which the insurance company controls by either capping the amount of increase you can get. So, for instance, if the market grows by 20% and you have an 8% cap, that means you would realize 8% of the 20%. Or they limit your participation. So you may have a growth of 20%. Let me use that example again. And then you may get only 60% participation in that growth, which means that you would realize a growth of about 12%. That's how the indexing works on the upside. On the downside, you are protected from any losses. So whereas in the direct market investment, if it goes down by 20%, you in fact would lose 20%, and oh, by the way, your advisor would still get their annual fees, so you would be out 20% plus whatever fees you're being charged. In a fixed indexed annuity, when you hit zero, that is the lowest amount you can make in any given measurement period. And those measurement periods are usually annually on the anniversary date of the fixed indexed annuity. So that is a very brief and hopefully understandable definition of a fixed indexed annuity. And now I'm just going to touch on very briefly the options that are available. And as I say, we're going to be referring to these in the later videos. The first one that's become very popular today is known as the premium bonus. Simply put, you put your money in and the insurance company gives you a bonus amount of say 10% for allowing them to make a 10-year contract a 14-year contract. So usually what happens with the premium bonus is they have that basic vehicle we talked about before, but by adding a couple of years on that basic vehicle, they'll give you 10% of your money. So going in, if you deposit $100,000, that $100,000 on day one will start to grow from a base of $110,000. Second option is an income rider, an option to get guaranteed growth for a period of time on your money if you commit to take the distribution in income, not in a lump sum. This will be the subject of our next video, and I promise you we'll go into very detailed explanations of how a specific income rider works. Now again, there are dozens of companies out there. I am contracted myself with probably about a dozen fixed indexed annuity insurance carriers, and they have all sorts of different options and different income riders and things of that nature. So we'll concentrate on talking about one of those because it's a rather robust one, but there are many other options that we can look at for our clients. Next option is called what I like to call specialized riders, and that would be for something like long-term care or guaranteed minimum death benefits, which will be the subject of another one of our upcoming videos. And then finally, there are some options out there now which are known as early contract termination annuities, which means that if you do have a 10-year contract on an annuity and you decide after 2 or 3 years that this is not what you had intended it to be, you can walk away with your money, usually minus any premium bonus you would have gotten, and then just basically take your money back and go and invest that money somewhere else. So not every annuity has every option, and there is a cost for these options. And again, when we talk about some of the options that are available, we'll go into some of those costs as well. Our next few videos will delve into the income rider and the specialized rider operations. Our final video in this series will actually delve into the profile of an annuity client and talk specifically about, is this something that is worthwhile for you folks to be taking a look at. Till next time, I want to thank you for your time. And if you like the video, please share it with your friends and family and invite them to view our upcoming videos on the Wealth Preservation Network. Or even better, click on the link to our website, complete the form, no obligation, complimentary consultation is available to you. And you have a wonderful day and happy retirement planning.